Hi, Derek Bisson here, and today's video is strictly for business owners. If you're an entrepreneur or business owner and you're looking to buy your own home this year, and you've already been trying to consider what type of loan program is right for you, this is your video. Now, if you've already been to your bank or credit union, you may have already come across some of the challenges that you may have in qualifying for a home loan. Spoiler alert, it has to do with your tax returns. If you're not familiar with what that means, it just means that your banks or credit unions are typically obligated to only use the portion of your income that you both reported and paid taxes on. If you're like many of my clients who are self-employed, they pay CPAs to lower their tax burden. And while life is amazing with a low tax burden, it can come around to bite you in the time that you're trying to purchase and finance a home. The good news is that if this does apply to you, there are plenty of options, and today we're going to be covering the top two. They're called bank statement loans and P&L loans, otherwise known as profit and loss statement loans. Now, both of these programs are designed strictly for business owners, but they work in different ways. So in this video, we're going to help break down both programs and help you decide which one is right for your business. Before we get started, a quick note for the channel. If you like this sort of content, consider liking this video, sharing, and subscribing. So in this video, we're going to cover the following topics. First, we'll cover the things that both of these programs have in common with traditional mortgage programs. We'll cover how income is calculated for each program, how to decide which program is right for your type of business, and then finally, the things that you need to know to qualify for each program. We'll start off by comparing this type of a loan program to a traditional conventional loan program. These programs have 30-year fixed-rate terms and sometimes ARM loans. There are no prepayment penalties. There is asset verification. In other words, the lender will verify the funds you're using for your down payment and closing costs. There will be a home appraisal. There will be title insurance, escrow accounts, transfer taxes that happen one time at closing, and a few other various closing costs that are specific to your region. Now let's cover the things that are different. The biggest difference you have with these loan programs versus a traditional loan program comes down to how the lender is able to calculate your income. This is how the lender is able to determine your ability to make the monthly payments on the new loan. For instance, with a traditional conventional home loan, the lender is restricted to using the tax return income that you file with the IRS, and then using the net income, the taxable income that you pay taxes on. That's about the easiest way we can describe it. Now, with bank statement loans and with P&L loans, they work differently. Let's cover how each works. With the bank statement program, the lender calculates the income by analyzing your bank statements. Specifically, you'll provide a set of the most recent 12 months of your business bank statements. The lender's going to count the ordinary business deposits that you make into these accounts. This can come from checks, point of sale company deposits, etc. They'll not count cash deposits, store returns, loan proceeds, tax refunds, store refunds, etc. Things that are basically not business. The usable deposits are then averaged, and then it creates a gross annual income figure. The deposits are placed into a spreadsheet and are also charted to determine your business's overall trajectory of performance over that 12-month period. So they're basically looking to see if your business is stable or if it appears to be growing, and hopefully not declining over this time. The third step is where the lender assesses your business expenses. You'll complete a short questionnaire about your business called a business narrative form. This includes questions about your industry, the size of your business, the number of employees you have, etc. The lender uses those answers to apply a predetermined expense ratio to the gross income calculation we did back in step 1. This usually ranges from about 15% to 80% depending upon your industry and a few of the other answers on your form. That ratio is then applied to the gross income. So for instance, if your expense factor is 15%, then we'll go back to step 2, and then we'll apply 85% of the gross deposit income from step 2. If the expense ratio turns out to be 25, then the lender can count 75% of the gross deposits from the previous step, and so on and so forth. Now, if that's enough income to qualify for the loan that you're seeking, that's great news because it means that your income calculation is pretty much done at that point. We try to keep things as simple as possible for you. However, if you're trying to go for a higher loan amount than we originally calculated for your expense ratio, then simply have your CPA or licensed tax preparer prepare a letter about your business stating your operating ratio, your expense ratio for the most recent 12 months, and your loan originator can guide you through how that type of proposal will look on paper. And that pretty much covers the bank statement loan income calculation. Now let's jump over to the P&L or profit and loss statement loan and see how that one works. Now the P&L or profit and loss statement loan is a much simpler income calculation process than the bank statement loan. Here's how it works. First, instead of analyzing bank statements or tax returns, the P&L loan program uses a profit and loss statement prepared by your CPA or other licensed tax preparer for the most recent 12 calendar months. And again, that is key here, not the most recent tax year, but the most recent 12-month period. The profit and loss statement will detail both your gross income as well as your expenses for that same 12-month period. The profit and loss statement will be analyzed for both gross income as well as expenses. So they take the gross income, minus out all the expenses that are on there, and then divide by 12. And then that figure becomes the monthly income for your new loan qualification. Now, a quick note on this program. The P&L will usually not align with the data in your tax returns. In fact, if it was, there would probably be no reason for this program. Mathematically, it shouldn't line up because the profit and loss statement is for a running 12-month period, not a particular tax year. It's there to give the lender the most accurate and realistic portrayal of your business's true profitability versus the tax return approach. One other thing you need to know about the profit and loss statement loan is that your lender may ask about the length of relationship that you have with the tax preparer who prepared the statement. They may want to know things like, is the tax preparer a family member of yours? If they've been preparing your tax returns for at least 2 years or longer, etc. The majority of lenders who offer this program are starting to care about this more and more, and there are still others who don't really care. We offer both here, but if you have a long-standing relationship with your CPA or tax preparer, and he or she has done more than, say, 2 filings, this won't apply to you, but it could affect you if you prepare your tax returns yourself or if you hired someone other than your usual tax preparer to prepare this specific profit and loss statement. Again, here we can help you either way, but we need to know this information up front. So be sure to consult with your loan originator. Okay, now we've covered how the program works. Now let's discuss which type of program is going to be right for your type of business. The bank statement program is designed for businesses that keep solid bank records, have traceable deposits from their customers, and have a stable or growth trend that's evident in their bank records. It's generally not designed for businesses that have seasonal income, businesses that only make a handful of deposits per year, no matter how large or small those deposits are, or for cash-based businesses. And the minimum down payment for a bank statement program starts at 10% of the purchase price. Now, the P&L statement or profit and loss statement loan is designed for all types of businesses, including cash businesses, seasonal income businesses, businesses that have only a few large deposits per year, etc. Again, in this program, the lender relies solely on the figures provided by the licensed tax preparer for income qualification. The minimum down payment for a profit and loss statement loan is 20% of the purchase price. Again, the right choice simply comes down to how your business operates, as well as how much you have saved up for the down payment and settlement charges. If you qualify for both options, you can choose whichever one's easier for you. You can always contact us and we can help you compare both options side by side. Now, here are the things you need to know to qualify for each program. Now, both programs are similar in their requirements, so the difference again comes down to income documentation. Under the bank statement program, you'll provide the most recent 12 months of bank statements for the accounts where your customer deposits are made. You can include bank statements for the most recent 3 months for any other accounts that are used for the down payment, closing costs, and reserves. This includes business accounts, personal accounts, retirement accounts, checking, savings, money market accounts, etc. Under the P&L statement program, you'll provide a profit and loss statement for the most recent 12-month period prepared by a CPA or other licensed tax preparer. You'll also include bank statements for the most recent 3 months for any other accounts being used in the transaction for down payment, closing cost, and reserves. This includes business accounts, personal accounts, retirement accounts, checking, savings, money market, etc. For more specific details, you can head over to my website, unconventionallending.com, and you can just find the particular loan program, including the links in the description below. And then you can go to the product support page for each of these 2 different programs, and you can download a document checklist that's specific to each program. That'll really help you get a head start on the documents you'll need. And that's it. We hope you found this information helpful. And if you'd like more information about the programs, again, check out the links in the description below. If you're looking to purchase your first, second, third, 10th, home and you're self-employed and you need some guidance on how these programs work, we would love to be of assistance. We lend in 29 states, and we would love to help you find your success in home ownership. Thanks again for watching. I'm Derek Bisson, and this is Unconventional Lending.